The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone to Nova 401k Associates webinar, 401k Loan and Distribution Basics with Melissa Cawood and Stephanie Reeve. Before we get started, I would like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions. This is where you will enter in any questions you may have for Melissa and Stephanie. Keep in mind that the Q&A portion of this webinar will be held at the end, and they will answer as many questions as time permits. Please be sure to make your questions as descriptive as possible, including the slide number if possible. If time runs out and you still have questions, please send them to our email address, webinars@nova401k.com. Right below questions, you will see the handouts drop down. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out our survey. This will allow us to track your time and participation. Certificates will be sent out within a week. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce to you Melissa Cawood and Stephanie Reeve. Melissa and Stephanie both work for our distribution and loan department here at Nova. Melissa is the head reviewer and trainer for this department, and Stephanie is the distribution team leader. Hey ladies, go ahead.
Thank you, Yvette. So we can go ahead and dive in. Melissa, since I'm kind of letting you drive, if you want to move on to the first one, just the first item to go over, just housekeeping item, is a disclaimer that the information in this presentation is intended to be general in nature. It's not intended to be a substitute for legal or tax advice. And if you do have questions of a legal or tax nature, please consult a qualified professional such as an attorney or an accountant. And as Yvette said, this is eligible for CPA credit. Nova's provider number is 009820. As long as you're individually registered and present for the entire webinar and you complete our evaluation form, then you'll get a CE certificate within about a week after the webinar. So today's agenda is going to include distribution basics, which I will present, and I'm going to go over the different types of distributions. I'm also going to discuss the special tax notices and also some taxation issues surrounding distributions. Then I'm going to turn it over to Melissa, and she's going to go through the loan basics, including maximums and information about loan defaults. She's also going to discuss vesting as it relates to distribution and loan processing, and she's going to discuss some of our more common problems that we see when we are processing distributions and loans. And she's also going to go over Nova's cybersecurity policies as well. So once we have completed the webinar, we hope that you walk away with this with an understanding of both mandatory and optional distributions that we have from 401k plans. And we also hope you're able to identify loan provisions and loan requirements, and also understand how vesting does apply to loan and distribution processing. So I'm going to dive here into the distribution basics portion. First thing is our overview here, just general overview. So once money is deposited into a 401k plan, you do have to meet certain criteria before you can withdraw the funds from the plan. I've listed some really common reasons below here, and I'll go into these in more detail in the presentation. The most common one is termination or retirement. We also see a lot of plans with an age of 70.5 distribution provision for employed participants. Hardship distributions might be available for employed participants. Of course, if a participant passes away, their beneficiaries are able to take funds from the plan. And then also when participants become disabled, they're often able to withdraw their funds from the plan. And then another common provision we see is a withdrawal of rollover funds that are made into the plan from prior employer plans. So our first item here is our termination and retirement. And again, this is the most common. We process the most of this type of distribution. I would say that would be true for pretty much any 401k plan. And this is a distribution that is initiated by the participant. So when they terminate or retire, they'll reach out to us or maybe to the record keeper or possibly to their employer and request distribution of the plan of their vested account balances. A couple key things about this, though, is that these funds can't be removed until after the participant is actually terminated. So, we do occasionally get requests where participants are going to terminate within the next week or so, and they'll want to start processing their distribution already, but we do have to wait till they terminate. And the other thing we do try to wait for is the final payroll contribution. And this is because if we process the distribution before the final payroll contribution, then you can get into a problem with subsequent distributions. And these can be a little problematic for the plan. When they're cash distributions, the checks sometimes don't get cashed, so you have an uncashed check problem. And then the other thing is there can be additional fees for processing additional distributions, and the record keepers often do require that you make a second distribution application. So again, it can be difficult to get these amounts out of the plan. They're typically pretty small. Sometimes participants are unhappy that they may have to wait another couple weeks after they terminate for that final contribution to be deposited. But we do strongly encourage that distributions not be processed until that final contribution is deposited to the plan. And then along with termination distributions, we have involuntary force-out distributions. And this is a distribution provision that allows a plan to force distributions for participants with small account balances. Typically, it's $1,000 or $5,000 is the threshold. And the reason why this exists is because these small account balances have a kind of a high probability of over time of the account sort of getting separated from the participant. So participants move and they don't change their addresses, or sometimes they will pass away. And we won't know, or the plan sponsor won't know that the participants passed away, and there's this small account balance that has to be dealt with. So in order to avoid some of those issues, we do recommend that plans have these involuntary force-outs. And most of our retirement plans do have these. The vast majority have force-out provisions, and we do help our plans force participants out. We actually run this kind of as an annual project for all of our plans. And if you want to move on to the next slide, we can kind of go into some detail on the force outs. So force outs can be set at $1,000 and $5,000. And I'd say our plans are largely set at $5,000. But you do have some options for the ones that have vested account balances under $1,000. You can pay that balance that's under $1,000 as a cash distribution. Typically, we recommend against this for kind of the same reason as we talked about for the termination distribution, and that is because these are smaller checks. Participants often aren't expecting to receive them, and they often don't cash them, so you run into that uncashed check problem. But if you do allow them as cash, what would happen is a participant's mailed a check for 80% of their account balance, and then federal withholding of 20% is mailed off to the IRS. But again, we kind of discourage this. Our plans are, I think, all written to have rollovers as the default for the under 1,000. If we'll move to the next slide, Melissa, we talk about that a little bit here. So our plan documents are updated so that we do use rollovers as the default for the involuntary, whether it's under $1,000 or under $5,000. And so when we have these force outs, one option plan sponsors have is whether or not they want to include rollover balances or exclude them when determining the $5,000 threshold. Most plans do exclude rollovers, although it is an option to include them. It's something you would want to check your plan document just to make sure, or you can reach out to us or your account manager to ask. The plan document does need to indicate that force outs are allowed and what limit is being used. And then these balances are rolled into IRAs in the participant's name. So participant comes looking for their account balance at a later date. We're able to point them to the IRA, and then they can go access the funds in their IRA, and they can then make a decision about what to do with the funds, whether they want to roll it over somewhere else or they want to take it as a cash distribution. And this gives the participant, a little more control over what to do with the funds. But the important thing is that we're able to remove the funds from the plan so that the plan no longer has to maintain these small account balances. If you have any questions about this involuntary forced out process, please reach out to us. Our contact email is on this slide. You can also call us. You can reach out to your account manager, and we can help you kind of work through the involuntary process and answer any of your questions on it. For participants that are still employed, there are a variety of distribution options. A really common one we see here is this age 59 and a half. And this is optional, it's not required, but it's really common to see in 401k plans. And this allows participants that are still actively employed to take distributions from the plan. It's often restricted to 401k money. Some plans do allow employer money to be taken as well. So we would have to look at your plan document to see what the actual provision was. The key thing though about the age 59 and a half, and one of the reasons why it's set at age 59 and a half for retirement plans, is that that's the kind of the magic age where you don't have to pay the 10% early withdrawal penalty. You do still have to pay federal income taxes if you take an in-service distribution. It's, when you file your tax return, you're going to have to declare the income like you do with any of your other income. But you won't have to pay a 10% penalty if you're age 59 and a half. And then another option participants have when they are active is a hardship distribution. Again, this is another optional provision, but it's very common in 401k plans. This helps participants who may be having an emergency get some access to their 401k funds. Now, this one usually is subject to the 10% early withdrawal tax. If you're over age 59 and a half and you take a hardship, then no, you don't pay the early withdrawal penalty, but if you are under age 59 and a half, then you probably will be paying it. And it's a taxable distribution, so again, you do pay income taxes on it. Hardships are given or allowed for very specific reasons, which I'll go into in another slide here. But one of the important things just to keep in mind for hardships is that it is very limited to the reasons why you can have a hardship, and also it's very dependent on documentation. So we have to be able to document the need clearly in order to process a hardship distribution. So the reasons for hardships, these are safe harbor reasons put forth by the IRS, are to purchase a primary residence or prevent foreclosure or eviction from a primary residence. And I do want to emphasize that this is primary. So if you want to take a hardship to purchase a second home or a vacation home, that's not allowed. It's only for your primary residence that you'll be living in. And then you can also take hardship distributions if you have some medical expenses that aren't being paid by your health insurance, or if you have some educational expenses for post-secondary education. And the medical and education provisions apply to the participant, their spouse, and also their dependents can all be eligible expenses for these two types of distribution. There's also a casualty loss. This is a kind of I think a bit of a newer provision. And this can happen when you have a situation such as if your house was destroyed by a hurricane, for example. You may be able to take a hardship distribution under a casualty loss provision. So it's not something that hopefully that very many participants will ever experience. But it is available, if you have that type of extreme need. Another one you can do is for burial expenses, and this can also apply not to just the participant and their dependents, but there are other relatives such as their parents that if your parents pass away, you may be able to get a hardship to pay for some of the burial expenses. And then another one we have here is hardships that are incurred as the result of a federally declared disaster area. So for example, if there's a wildfire and your house is damaged in the wildfire and a disaster areas declared, then you may be able to take a hardship to pay for home repairs. So those types of situations are included in the hardship for the federal declared disaster. And again, you have to have that federal declaration to be eligible for that type of hardship. And then I also wanted to go over some changes that occurred fairly recently in 2019. And I know for some of us, 2019 seems like a lifetime away, but it really was only a couple of years. And some people are not aware that these changes happen, so I do like to point them out just to kind of remind everyone. So before 2019, participants had to take a plan loan if it was available before they could have a hardship distribution, but that's no longer required. So participants do not have to take plan loans before they can have hardship distributions. Another one that we really liked, another change we really liked here is the second one about the investment earnings. So before 2019, a participant was not allowed to take their investment earnings. They could only take the amount of contributions they had made to the plan, which could be a little difficult to administer, particularly when you had a participant who had multiple hardship distributions. But now we no longer have to make that distinction. If the plan allows a hardship distribution, the participant can have their full 401k account, assuming that they have the documentation to substantiate that amount. The other thing that went away was the requirement that participants stop their 401k contributions for 6 months. So prior to 2019, participants had to stop making contributions for 6 months if they had a hardship. That's gone away. Participants can continue to make their their 401k contributions even if they take a hardship distribution. And these are items that have already been adopted for the plan documents. Your plan documents have been updated with them for the last few years now. If you have questions, please reach out to your account manager, but I did want to kind of point them out for those who may not realize we had these changes. And then a couple of other things about hardship distributions is that, they used to be, kind of limited to 401k. Now plans are allowed to offer employer sources. Most plans still just limit it to the participants' 401k contributions, but there is the option to expand it to include other sources of funds within the plan. And then, of course, I mentioned this before, but we do need to substantiate the hardship. So we do have a pretty detailed list of what we will accept, to prove that a hardship exists. So invoices, medical bills, receipts. If it's, for example, if it's an eviction, we need to see an eviction notice, that states the amount the participant owes to avoid eviction and when it needs to be paid. So that type of documentation is required to process hardship distributions. And then participants also have to sign a certification that essentially says that they do in fact have this hardship and they don't have another source of funds to pay for the expense when they submit their hardship application. And then another common type of distribution that we see in plans, again, then this typically applies to active participants, is that participants are allowed to take a distribution of funds that they've rolled into the plan from another plan. So this is usually in place in order to encourage participants to roll funds into a 401k plan. Participants are more likely to roll them into the new plan from their old employer's plan if they know they can access them if they need access to the funds. So that's why a lot of 401k plans do have this provision. This again is an optional provision, though it's not required, but we do see it frequently in 401k plans. And then another, unfortunate type of distribution that is available from plans is death distributions. Participants who pass away, their beneficiaries are generally able to have access to their funds. Beneficiaries distributions are going to be based on ideally a beneficiary designation. We very strongly encourage plan sponsors, employers to maintain beneficiary designations for their participants so that if the participant does pass away, the funds can go to whoever the participant really wanted to have the funds. Married participants are, by federal law, the beneficiary for any retirement account. Unless the spouse waives that right, and they have to waive it in writing and agree to the new beneficiary. So if someone does want to designate someone other than their spouse, for example, if they want to designate their child, if they're married, their spouse does have to agree to that in writing. If we don't have a beneficiary designation, the plan document does have an order of who's paid out. So spouse being first, obviously, since they are the default beneficiary. If there is no spouse, it goes children, parents. Eventually, it will get to the participant's estate if we run out of relatives named in the plan document. We do, again, encourage people, though, to have beneficiary designations on file, because we've seen a lot of situations where the participant didn't have a designation on file, and the person that the participant may have wanted to get the funds doesn't get the funds, and it can create a lot of unpleasant situations. We obviously don't get involved. We're just there to process the distribution, but we do have sometimes get some communications from some very unhappy people because they didn't inherit a 401k just a 401k account. So again, we encourage employers to make sure they have those on file. And then, of course, any distribution that's submitted to us for a death does need to have a death certificate, just so we can, again, substantiate that the participant has, in fact, passed away before we pay out their beneficiaries from the plan. Another common type of distribution we process are required minimum distributions. So a few years ago, the age for these was age 70 and a half, but it's now age 72. And this is an annual requirement that employees who are age 72 or older do need to take annual distributions from their 401k plans. Just kind of a little side note here, if we have a participant that's over age 72 who wants a rollover from the plan to maybe roll it to an IRA, that's fine, but we do have to process a RMD in cash before we can process the rollover distribution, because RMDs are not eligible to be rolled over for participants that are age 72 or older. And these RMDs will apply to two groups of people. The first is the terminated employees that are age 72. Those employees do have to take RMDs every year. And then the other group is actually a group of active employees. And these are owners of the company sponsoring the plan. If they're age 72, even if they're still, considered actively employed with the company, they do have to take their RMD every year if they're a more than 5% owner. Employees that aren't owners that are still working past age 72 can typically delay their RMD until they actually do terminate or retire. And NOVA does kind of an annual RMD project for our plans every year. So this is something that we do look out for our clients, and we do try to identify all of these age 72 participants and make sure that they get their RMDs every year. And then another type of distribution that we see and that you may see come across your desks as well is a qualified domestic relations order, call them a quadro for short. And these are usually because of a divorce. So we have a participant who gets a divorce, and their spouse typically is assigned a portion of their account. These are, pretty complicated, and it's kind of important to remember that these can take a while to process. They usually take, a few weeks. Sometimes they can take a few months to process, but they do require court orders assigning the benefit to the spouse. So it can't just be, kind of like a verbal agreement between the participant and their former spouse. It does require a court order. The court order has to have specific type of information in a specific format. So, if you get those coming across your desk, please forward them to us. We process a lot of them, so we do know how to get those processed so we can get those paid out as quickly as possible, even though that process is usually not very quick. If you want to move on to the next slide, Melissa. The other thing I wanted to go over is spousal consent. So fortunately, most 401k plans no longer require spousal consent. The ones that do usually only require it for vested balances that are over 5,000. Spousal consent used to be a little more common, but it's pretty rare nowadays. You will sometimes see it if a 401k plan has some old money purchase plan money. This is a money purchase plan, is a type of plan that mostly has gone away. There are a few still around, just, that maybe have been in place for 30 or 40 years. So most money purchase plans are no longer in existence, or they've been converted to profit sharing 401k plans. So we do, when we process distributions, we do look out for, plans that have old money purchase money, but typically that's going to be a plan that's been in existence for a while for it to even have money purchase money in it. And then the other types of plan that does require spousal consent is defined benefit. And this is your typical traditional pension plan. It's going to pay, $500 a month when you retire, or whatever the benefit is. And those plans do require spousal consent. But luckily, 401k plans don't usually have to worry about it. Another important thing about distributions is that when participants request a distribution, they should be given a special tax notice, and this is usually included with the distribution paperwork. So distribution form participant fills out. If it's paper, will typically have a special tax notice attached to it. If they apply for a distribution electronically online, then there will typically be a special tax notice for them to view as part of that process. It's just important that participants do get this because it explains the tax consequences of taking a distribution. So we'll explain to them, that if they take it in cash, that they have to pay income taxes on it, or if they roll it over to an IRA, they can avoid income taxes. So this type of information is included in that notice, and it's just important that participants get it so they're fully educated, about their distribution options and consequences. And then as far as some taxation issues surrounding retirement plan distributions, so typically cash distributions from 401k plans are subject to 20% federal withholding, meaning that if a participant takes a cash distribution, they'll actually get 80% of their vested balance, and then 20% will be sent to the IRS for them. And if they're under age 59 and a half, they do typically pay a 10% early withdrawal penalty. There are some exceptions to that, but most participants under age 59 and a half will pay that penalty on a cash distribution. And it's just important participants realize that cash distributions are taxable income. So when they file their tax returns for that year, they will have to claim the distribution as income. And another important thing that I think a lot of participants don't understand too is that the 20% withholding is required, but it's not necessarily their tax liability. They may owe more or less depending on their tax situation. The 10% early withdrawal penalty is not taken at the time of distribution. It's typically something paid when a participant files their tax return. Participants are allowed to choose a greater amount of tax withholding when they take a cash distribution. So if they wanted to take 30%, for example, they can usually make that election. But 20% is required, and then sometimes they can elect more if they choose. Kind of the exception to the 20% tax withholding includes distributions that aren't able to be rolled over. So for example, hardship distributions aren't eligible for rollover. So they're not subject to the 20% tax withholding at the time they take the distribution. It's the same with RMDs. Those are also not subject to the 20% tax withholding. Both of those types of distributions are still taxable to the participant. They just don't have to pay tax withholding when they take the distribution. They can wait and pay it whenever they file their tax returns. Rollover distributions are a great way to defer tax. So if you roll your funds over to an IRA, typically you don't have any tax liability when you do the rollover. You'll have it, further on, maybe years later when you actually withdraw the funds from your IRA, you'll pay taxes then. But the rollover itself is not usually taxable. An exception to that is that if you do a Roth conversion with your rollover, so if you have pre-tax funds in your 401k plan and you roll those over to your Roth IRA, that Roth conversion will be taxable to you, but the taxes are not taken out when you do the rollover. Any taxes you might pay on a Roth conversion are paid when you file your tax return later on for that year. And then as far as rollovers go, you know, you can roll them to an IRA, or you may be able to roll them to an employer's plan. So, you know, you may have participants may have a few options there when they're doing their rollover as to where they want those funds to go. And then on our next slide, we are going to go into loan basics. And at this point, I'm going to turn it over to Melissa, and I'll let her take over from here.
All right, thanks, Stephanie. Okay, so loans. The first thing that we need to know is that these are optional. Your plans do not have to allow them. And there are some pros and cons to loans. So let's get into that. One of the pros to that is that it allows the employees to access their 401k funds when they need them, and that can help to encourage participation. People are less likely to agree to give it part of their paycheck if they feel like they're not going to be able to touch those funds for a very long time. If they know they have an opportunity to take a loan when something comes up, they're more likely to agree to participate. It can be a little bit burdensome for the plan sponsor, though, because you do have to maintain those loans, make sure they're being paid off, set a payroll deduction, things like that. But one thing that is nice about the loan provision is that you can make it more restrictive if that's something that you're interested in. It's very flexible. So if you don't want to allow people to take an infinite number of loans, you can set a restriction, one loan at a time, for example. Loans, a pro for them is that they are not taxable. All those situations Stephanie just talked about do not apply to loans, as long as they are paid off within usually 5 years from when they're taken. Loans, on the side it says they must be repaid via payroll deductions. That's typically how it is set up in the loan policy. It'll state payroll deductions are required. You could allow somebody to do through paychecks, through personal checks to the plan, who can then turn around and submit them for that participant, but definitely not something we recommend. We recommend payroll deductions. And then if your plan does not currently allow loans, but it's something you are interested in turning on, it would require a plan amendment to take place, and then a loan policy for your plan would have to be written. Okay, so there are some parameters that all loans from 401k plans have to stay within. And the biggest parameter is the maximum loan amount that is allowed. So participants can only take 50% of their vested account balance, not to exceed $50,000. That $50,000 is also going to be reduced by the highest outstanding loan balance in the last 12 months. That is something that people often overlook. And we will get into it a little bit more on a later slide, but the 50% is only up to $50,000. So if somebody has a $500,000 account balance, they still cannot take more than $50,000. If somebody has a $2,000 account balance, they can only take half of it, which would be $1,000. So we do have some recommendations. We have some defaults that we use when we are preparing loan policies. It's not a requirement that you stick with NOVA recommendations. It's just what we recommend to help make having loans not too much of an administrative burden. We recommend having only one loan outstanding at a time. If you wanted to, you could have an infinite number of loans outstanding at a time, but that can be very hard to keep track of, as you can imagine, I'm sure. We recommend having a minimum loan amount of $1,000. Some plans, you know, if you wanted to, you could do less than that. But again, you want to help encourage participants to get that account balance going before they start dipping into it. So that's why that minimum of $1,000 is going to be our default. On here, it talks about the loan repayments. We recommend that you require repayments to be made through payroll deduction. If it's set up through payroll, a participant cannot forget about it. It's also a lot less of a burden on the participant, because if they never even see the money, you know, it's just a lot smoother of a process. And spousal consent is generally not required for these. You could require that if you want to, but because they're being paid right back, it's just not something that is needed in most cases. Okay, so part of the loan requirements that if we're going to have a loan policy for your plan, one of the things in there is that we have to have a reasonable rate of interest. Well, what does that really mean? Nova goes off of the prime rate. When we are writing a loan policy, our default is going to be the prime rate plus 2%. And that is because it is uniform, so it's going to be the same across the board. Anybody requesting a loan at any time would be given the same parameter for the interest rate. Now, interest rates may change depending on how the prime rate changes, but it would be fair in the sense that everybody would be getting the same prime plus 2%. Again, it's not a requirement that you have prime plus 2. The requirement is that it has to be a reasonable rate, and you have to be able to have that uniformly across the whole plan. Any participant would need to be having that same standard. The maximum term for loans, maximum amount of time that a loan can take to be paid back is 5 years, generally speaking. That is not a Nova recommendation, that's an IRS regulation. The only exception is for residential loans. So if a participant is taking a loan to purchase their primary residence, then the loan policy would have a different length of time in there. Typically, it's 20 years. You could state in your loan policy that you wanted it 10 years. You could state 30 years. But we have to think about, is that participant going to be employed for 30 years? You know, probably not. So 20 years is typically the maximum amount of time that we see for those loans. If somebody is trying to get a loan for more than 5 years, they do have to provide documentation of that home purchase along with the loan request. But typically 5 years is all that's allowed. Typically they're paid through payroll deduction. And you'll see in the parentheses there, that's something that most people do not realize. It is on a post-tax basis. So a participant has money coming out of their paycheck. Let's say it's elective deferrals, that's pre-tax money going into the plan, pre-tax account. Well, if they take a loan out and then they have to start making repayments on it, those repayments are done on a post-tax basis and they are going back into a pre-tax source. So it's not necessarily a bad idea. I myself have taken a loan for my 401k, but it is something that you need to consider, that a participant would really want to consider if it's worth what they're doing. It's not an ATM, you know, it's not a checking account, it is a little bit different. So loans also become due when a participant terminates their employment. If loans are made through payroll deductions and they're not getting paychecks anymore, the loans are due. So the participant would need to either make a lump sum payment, one-time payment to get that loan paid off, or that loan is going to be defaulted or deemed as a distribution, and the amount of the outstanding balance is going to become taxable income for that participant. So we'll get into that a little bit more on a future slide. For the loan requirements, if they're not followed, it is a prohibited transaction. If a loan is allowed and you do not have loans written into your plan document, that is not okay. So that amount that's taken from the plan, or if the loan is not repaid properly, that amount becomes taxable. It is deemed as a distribution. If the participant is under the age of 59 and a half, they're going to be subject to that early withdrawal penalties. That's that 10% excise tax that was referenced earlier. That is going to be subjected on any loans that are taken that are not following the loan requirements. So it can be a big deal. It can be a big burden from a tax perspective for participants. It's really important that we know what the loan policy states and that we are following it. There are fees to processing loans. There's loan initiation fees. Nova does charge a loan initiation fee. It is typically $100. You can check your engagement agreement to see exactly what it is for you, but that is their typical fee. The vendors or record keepers, you might hear that term, they also typically charge a loan initiation fee. Theirs is going to be smaller. depending on that record keeper. The record keepers also charge an annual fee to maintain the loan. Some record keepers like to do it as a monthly fee. Some of them do it as a quarterly fee, but there is going to be a fee that the participant is paying over the life of the loan to maintain that loan. And that is the record keeper fee there. And the participants are going to bear the cost of these fees. If you really wanted to, you could talk to us and set it up so that the plan sponsor is paying the loan fees for the participant. But that's rare. If the participant's the one wanting this optional loan from the account, they're the ones that would typically pay that fee. Okay, the big thing with loans is that when a participant requests one, they wanted that money yesterday in most cases. So it's not like a termination where they're doing a rollover and they've got time. They are requesting that money because they need that money for some purpose and that has a deadline, and they want it as fast as possible, understandably. So how can we expedite the process? The first thing is to make sure that we understand it for your plan, for your specific record keeper. We work with so many different ones, and we do know all of the different unique quirks of each record keeper. Some of them only allow loans online. Some of them only allow loans on paper forms. Some of them have both. So knowing how the process works, knowing exactly how to request a loan, and knowing what advice to give your participants in advance can really help to speed that process up. I will tell you, if there's an option, the participant should always apply for a loan online. That tremendously helps speed up the process. There is always issues with paper forms. Sometimes, especially if a form is being faxed in, sometimes the quality just degrades in a fax. Sometimes numbers are hard to read. With paper forms, sometimes participants might forget to check a box or fill out a specific line item. The online requests, we won't have any issues with not being able to read it. They also can't skip over something. The system won't let them submit the request until they filled in all the required information. So it really prevents us having to put a request on hold to reach out for more information before we can process. The other amazing thing about the online systems that all the record keepers have is that the participant can go online, they can model different loan scenarios. They can look at, okay, what is this loan? What are my repayments going to look like if I take it for 3 years or 5 years? They can look at how much of a loan that they can take. What's their maximum? What's their minimum? All those questions can be answered right there on their account online. So we highly recommend going online first. Another way to help speed up that process is for the participant to request an ACH payment instead of a paper check. I don't know if that's everybody's experience, but mine has certainly been that the mail is a lot slower ever since COVID happened. And paper checks are taking 7, maybe 10 days to arrive in the mail, depending on how far away the participant lives from where the check is being mailed at the record keeper office. ACH, depending on the bank, can take 1 to 2 days, depending on the participant's bank. So it's not always possible. There are a few record keepers that will not do anything other than checks for loans. But if you have that option, an ACH is way faster. And then, of course, we need to make sure that the participants know this is not an ATM withdrawal. This is not something that they're going to have same day. They are going to have to wait. These requests are routed to Nova usually, so we can check for vesting. We make sure that the loan policies are being followed. Then the plan sponsors are going to have to approve the loan, make sure the biggest thing that plan sponsors is looking for is to make sure a terminated participant isn't trying to request a loan. These are only going to be for active employees. And sometimes, we might not know a participant terminated last week. So that's, the kind of thing plan sponsors are going to have to look at. Then the record keeper has to process it. And while they're usually very fast, that can add a day. And then, of course, time for the check or the ACH payment to be sent through. So helping participants know in advance approximately how much time it will take, generally, in my experience, helps to make sure that they're calm and understanding throughout the waiting process there. Okay, so now I think I've got some examples. Participant A, this is a very simple one. If their vested account balance is $2,000, they want a $1,000 loan and they want to pay it back in 2 years. Are they allowed to do this? Is this an okay request? The first thing you do is look at the plan document. This particular example, the plan document does allow for one loan outstanding, and the minimum loan is $1,000. So then we look at 50% of their vested account balance is also $1,000 in this very easy example. So yes, this loan would be approved and we would be able to process this. Okay, in our next example, we have a little bit different situation. We have participant B with an account balance of $2,000. They have an outstanding loan already of $400 and they need another loan. They're requesting a new loan of $1,000. So the first thing we do again is check the plan document. This plan does allow 2 loans at a time. Okay, so now we can move on and let's see if they can take this loan. They're requesting the minimum withdrawal amount, so that's good. So now we have to do that calculation of their 50% of their vested account balance. 50% of the $2,000 balance is $1,000, but we have to factor in that current outstanding loan. That outstanding loan has to be subtracted out of there, and that makes the maximum loan that we could allow is $600. Because the plan has a minimum loan amount of $1,000, and this $600 is less than that, we would not be able to process this person's request. We would have to deny it. Okay, so let's look at this other example. And this is the one that trips people up a lot. So we've got participant A again, but this participant A's balance is much larger at $100,000. In February, they borrowed $30,000, and you know what? They repaid it in 2 months. By April, their outstanding loan balance is back down to 0, and so they apply for a second loan. So we have to look at what's the maximum loan we can give this person. Well, 50% of $100,000 is $50,000, and that is the maximum amount a loan can be approved for. But we have to look at the highest balance within the last 12 months. And we have to subtract that out of the $50,000 maximum. In this case, the participant can only borrow another $20,000. This situation is something that I highly recommend. If you have a participant with a very large loan balance who is looking to repay a loan specifically because they want to take another loan, I would recommend that they reach out first. Reach out to Nova. Let us explain to them the situation before they make any loan repayments to pay it off. I've seen it happen where somebody borrowed $30,000. They were like, wait a minute, no, I really needed 50. They repay the 30 really fast and turn around and try to get 50. And that's not allowed according to IRS regulations. So that's a situation. Have them reach out. We have absolutely no problem letting people know what their maximum loan amount will be in certain scenarios. If I paid this loan off, what will my highest balance, what am I allowed to take next? That piece of information would have been very helpful for that one person who paid $30,000 just to be told that now they can only take 20. It did not help them at all and actually put them in a pretty bad financial situation. So definitely don't forget that part of the calculation rules there. Okay, I think next we have some recommendations to avoid loan defaults. So loan defaults happen when the loans are not being paid. And sometimes they're not being paid for different reasons. Sometimes they don't get paid because the loans never got set up in the payroll system. Sometimes companies switch payroll providers, and when the switch takes place, the loans don't get set up in the new system. Sometimes people go on leave of absences, and sometimes people terminate employment. So terminating employment, that is what happens. If you don't pay that loan back, it defaults, it's deemed a distribution, and they have to pay taxes on the outstanding balance. That is the process. But for all those other situations, we definitely want to avoid that default because it can be very costly for that participant who's affected. So again, we recommend you only allow payroll deductions. If you were to allow a participant to write their own checks to make their loan repayments, I mean, participants are going to forget. They're going to be like, oh, money's tight this month. I'll wait till next month. And then they might forget in the future. Like, it's just not, it never works out as well as people intend. Intentions are good, but things happen. So set it up in payroll, set it up immediately. You can set it up in your payroll system in advance. Make sure you have that date that it's going to start. It's set up for the future, and then you should be able to enter a total goal amount in your payroll system. So you would look at the number of payments times the payment amount. If somebody is supposed to make 30 $10 payments, your goal amount would be $300. So set that goal amount up, set that start date up, and then your payroll system should be able to automatically handle that and turn the payments off when the loan is paid in full. If you have a participant who goes on a leave of absence, it is extremely important that you let your record keeper know right away. Let's say somebody's on maternity leave and they're going to be gone for 3 months. Let the record keeper know immediately so that they can put that loan on hold. Most of the record keepers do not ask NOVA to be involved in the loan default process. Some of them do, but a lot of them do not. If you have any questions about whether or not we're involved, just come straight to us and we will help you alert that record keeper. What the record keeper will do is they'll freeze the loan or put it on hold. The loan is still going to accrue interest, but it will not default. When that person comes back to work, at that point, the loan can be taken off of hold, can be re-amortized, and then it can continue on like normal. So that will help prevent the participant from owing taxes on the outstanding loan balance, if they shouldn't have had to be in that situation in the first place. So definitely the leave of absences are important. A loan can be put on hold for up to a year. So whatever the situation is, reach out if you have somebody who is going to be coming back to work. Okay, so if you do have a situation where we've missed loan repayments, maybe we forgot to set the loan up in the system or whatever the situation is, we've got missing repayments. Maybe they went on a leave of absence, the loan was frozen, and now they're back to work. We have two real options. The first one is that the participant can make a lump sum payment of the total amount missed, and they do it right away, and then they just go back on track, just follow the rest of the amortization schedule for the loan, and it will be paid off in time, no big deal. If the participant has only missed 1 or 2 payments, that's probably a great option, not a big deal. If that participant has been missing payments for 6 months, well, they might not have the amount of money needed to get them back on track. In that case, we can re-amortize the loan. It is not quite the same as refinancing. We would not change the interest rate. We would not change the maturity date. We're going to keep all that the same. All we are going to do is to increase the payment amount so that all the interest that has been accumulating can be absorbed back into the loan. And then by the end of the loan, by that maturity date, the whole thing will be paid off, including that interest that is accumulated. So there is a grace period built in for when these corrections can take place. If the loan is not taken care of or fixed before the end of that grace period, that is when a loan default occurs and when the loan is going to be deemed as a distribution. So the grace period here, it's written down there, it looks like a tongue twister. The last day of the calendar quarter following the calendar quarter where the first payment was missed. So basically, if somebody missed a payment, let's just say January 12th, they have until June 30th. That's the end of the quarter following the calendar quarter in which that first payment was missed, January 12th. They have until June 30th to make up that missing payment. If a mistake happens at the beginning of the calendar quarter, they got a lot more time than somebody who makes a mistake at the end of the calendar quarter. So just keep that in mind. It's not necessarily the end of the world. If we find a loan that is missing payments, reach out to us, let us know, and we will help you get that fixed. Okay, moving on, let's talk about vesting really fast. We've talked about vesting. You have to know how to figure out vesting for how to know the maximum amount a participant can take in a loan, or when they're terminated employment, what to pay them out. Employer money types are subject to vesting. We have a vesting schedule that will be in the plan document. There are certain amounts of, or certain sources that are always 100% vested. Any employee sources, safe harbor, QMAC, and rollover. These are sources that do not have to be earned by the participant. Your employer match, profit sharing, that has to be earned by the participant, and they earn it by years of service to the company. So there's two different methods. There's one is the hours method. This is the more common of the method, and depending on your perspective, it may be considered more fair. But basically, they have to work a certain number of years or a certain number of hours each year to get credit for that year of service. So it's going to be credited for the plan year, and it's going to, 1,000 hours is the magic number that a person has to work. The vesting is going to be calculated from that original date of hire, not the date that they become eligible for the plan. So we're going to look at their entire employment history. And if you have a plan or a business where you're not tracking hours, let's say everybody's salaried, we do have equivalency methods that we can use instead. Typically, it's 190 hours per month that the participant worked. The average person full-time takes about 6 months to work 1,000 hours. So even your part-time people are going to work 1,000 hours in that full year. The elapsed time method is less common. It is my favorite because it is very black and white. And depending on your perspective, this one could be considered more fair. It just depends on, you know, how you think about things. But it's literally 1 year. It's based on the person's anniversary date of their hire date. So if they're hired, you know, January 1st, well, they got to work that full year until the very end of December to be given a credit for 1 year of service. It does not matter how many hours they worked. I like this one because we don't have to reach out to plan sponsors to find out how many hours did this person work. It's very black and white, very easy in most cases to figure out exactly how many years of service they have. The only time it gets tricky is if they have left and come back and left and come back. Multiple rehire dates can make it a little trickier, but typically this is a very simple way to do it. It's just not as common. Most people do the hours way. So we have a couple of vesting examples here. And this one uses a 3-year cliff. So you see in that box there, after 1 year, 2 years, nothing, and then all of a sudden 3 years, they're 100% vested. So we have this person, participant A. We know that they have 2 years of service. We know that they use a 3-year cliff, and we know that they have $5,000 in deferral and $3,000 in match. Let's say they terminate their employment and they are looking to take a distribution. So the deferrals are always 100% vested, but the match on a 3-year cliff, if they only have 2 years of service, is still 0% vested. We would give that person their $5,000, and then 100% of the match is going to be transferred to the plan's forfeiture account because the person did not work enough hours to earn that money. In our next example, we have a person with 4 years of service on a 5-year graded scale. So 1 year is 20, 2 is 40, on and on to 5 years is 100. They have 3 different money types here. They've got deferrals, profit sharing, and safe harbor. Let's say they terminate employment. We know that the deferral and safe harbor contributions are always 100% vested. But those profit sharing contributions were subject to the 5-year graded schedule. They have 4 years of service, they only get 80% of that total account. So the amount that we would give to this participant is $3,800, the deferrals, the safe harbor, and then 80% of the profit sharing. The remaining 20% of the profit sharing is going to go into the plan's forfeiture account. Okay, so we have what we call NIGO, which is not in good order. And the most common problems we put here on the slide, with distributions, the most common reason to put something on hold is lack of date of termination. We recommend that you put, when you're submitting a person's final contribution, go ahead and update the record keeper at the same time with that term date. For loans, one of the most common reasons we have to put a loan on hold is that they won't give us the length of time they want the loan for. So, how many years do you want to take to pay this loan off? If they're doing an online request, that has to be filled in before it can come to me. So again, with loans, we definitely recommend those to be done online. And with hardships, the most common reason we put them on hold is because we do not get any kind of documentation. We'll only get the form, maybe the certification. So definitely encourage your participants to gather up their documentation, any bills they might have, things like that, and submit it with their forms. And then I just wanted to really quickly touch on the cybersecurity here at Nova. There's a whole list here that you can look at of very sensitive things. These items have socials, dates of birth. A lot of cases we've got addresses. We have all kinds of very sensitive data for your participants, and we take it very, very seriously. We never want you to send any of these via email without encryption. On the next slide, we're going to talk about how we can keep these secure and what Nova does. We have our portal there. It's also on every single email that a link to it is on every single email that any Nova employee will ever send you. This is our plan sponsor link, and it has a secure file transfer feature where you can select your account manager or whatever person you're looking for, and you can send them files securely. You can also send it directly to the Nova Distribution team. We have a setup. Nova is the first name, Distributions is the last name. So you don't have to worry about if your account manager is in the office or not. You can send participant requests directly to us in a secure way using Plan Sponsor Link. We utilize encryption software. We authorize new plan contacts before we update our system. Nova employees have mandatory training every single quarter. We have password policies where we change our passwords at least every 90 days, and we have to provide a document proving that. We also use two-factor authentication in every situation that we can. So Nova takes security very, very seriously. If you do need to email something, please reach out to us first and ask for us to send you an encrypted email that you can safely respond to. And then that way, at least the documents that you send are going to be sent via encryption. Okay, so then I just want to give a reminder about the CPA credit. Stay on here and get that. There'll be a link sent out, and then you can fill that out and you'll be able to receive your certification for that CPA credit. And then finally, if you have any questions, we have our phone number here. That phone number at the top is actually our participant line. It rings at multiple people's desks. So there's a high probability that that line will be answered by a person if it's from 7 a.m. to 7 p.m. And then of course I've got Stephanie's information and my information as well. Please want y'all to reach out with any questions that you may have.
All right, and then we're a little bit over time. Did you guys want to go ahead and read a couple of, or answer a couple of questions before we go? Do you have a couple minutes?
Yeah, I don't mind.
Okay, perfect. So our first question is, do you have any recommendations or suggestions for plans that fund employer contributions annually, whereby a terminated participant may be paid out as a date of termination, but all contributions have not yet been funded?
I'll take this one. So typically for those plans, we actually don't hold those distributions. We will go ahead and process the initial distribution when the participant terminates, and then we will be able to process another distribution later on when the contribution is funded. Typically in those cases, the contribution amount is hopefully large enough that the participant would want to apply for a distribution. With the holding it for the last payroll contribution, typically those amounts are pretty small. That last 401k deferral or match contribution can be pretty small. So that's kind of where you run into trouble with the subsequent distributions maybe not being cashed by the participants. But if it's an annual contribution, we'll go ahead and process the initial distribution, and then the participant can get a second distribution once the annual contribution is funded. And in a lot of cases, participants aren't eligible for that annual contribution, so they may not even get it. But if they do get it, they can they can apply for a second distribution.
Okay, perfect. And then our next question is, for eviction hardship, do you require final notice of eviction? Would this be noticed after a landlord has filed in court, or is a landlord's 5-day notice or other eviction notice sufficient?
So typically that initial 5-day notice, or I know different states do different days of for required notices, but that typically is sufficient. Sometimes, depending on like if it's after that deadline, we will ask the participant to, let us know were they given an extension, or if they pay, will that stop the eviction process so that they can continue to stay at the home. And as long as we get written confirmation of that, then we'll continue on. We won't make them wait and send us in additional documentation.
Okay. How are death distributions handled when there is no beneficiary designated? There are no relatives and no one who was responsible for the estate can be found.
Do you want to take this one, Melissa?
This is definitely a tricky situation.
It's a difficult one.
Yeah, hopefully it's not a common one either. It's definitely not common in my experience. So if there's no like relatives and things like that, then it would go to the estate, but to figure out who is the executor of the estate is a little bit tougher. So we have been known to look at participants' obituaries if we can find them, and then try to reach out to people mentioned on those obituaries. This is where you have to get a little bit creative sometimes. We'll first start, it depends on how long they're gone too. But if you can find names associated with that person and start reaching out, and sometimes it can take a little bit. It's definitely a lot of work to get those accounts tracked down or those people tracked down. But definitely when we'll send out letters, we'll be kind of generic with the letters we send. We don't want to be promising that any specific person is the one who would be getting the distribution forms to fill out, because until we've looked at all the data, we wouldn't necessarily know that. But our goal initially is to get people to reach out so we can get more information. We'll do locator searches. We do have the ability to do those. So if we do have like names, or we know maybe people, we can't find them, we'll try that way. We've gotten on social media to track people down before. Like if we know who it is, but not necessarily how to contact them. So it's definitely not easy, but we can't force those accounts out because the various rollover providers cannot take them from deceased participants. So we would have to wait until we found somebody for the estate.
It's just another plug here for, do what you can to get those beneficiary forms on file.
Yes.
Okay, I got another one for you guys. If a disqualified person who is 100% owner defaults on a plan, is it subject to the 15% excise tax penalty reported on the form 5330?
So if we're talking about a plan loan, if the loan does default and a form 5330 has to be filed, doesn't matter if it's a owner or just a non-owner participant. That doesn't make a difference if that was the question, whether it's an owner or not.
Okay, and looks like we have one more. For existing loans, can terminated participants be allowed to repay their loans post-termination via ACH or check so it doesn't default?
So those do default. Melissa maybe can answer this a little bit better. Do any of our plans allow terminated participants to make loan payments? Because it's a pretty unusual provision nowadays with loans being via payroll deduction. It's very rare to allow a participant to make loan payments after they terminate, because typically those participants do eventually default, and You know, a lot of the vendors we work with don't want to even take those checks, you know, for participants to make, you know, biweekly or monthly payments.
Yeah. Yeah, I have seen it. You would have to look at your loan policy to see if that's something that was allowed. If it's something you wanted to allow, I mean, theoretically, we could write that loan policy that way. But I can tell you most record keepers will not accept the loan repayments from the participants. So what you have to do, if your plan was to allow this, is to have the participant pay the loan repayment, and then the plan would have to then submit it just like they would if the participant was an active employee. So it is definitely a lot trickier. There's some more moving parts there, but the loan policy would have to allow it first.
Okay, perfect. All right, and I believe that is all the questions, unless you guys have anything else you'd like to input before we close out the session. Nope. Okay, well, thanks again, everyone, for joining us today. Just a reminder to fill out the survey at the end of this webinar so that we may track who will be needing a certificate. If you have any questions, please be sure to email us at webinars@nova401k.com. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, and that is Nova 401k Associates, or you can visit us at our website, which is www.nova401k.com/webinars. Thanks, everyone. Enjoy the rest of your day.